As I'm recording this, the United States and Israel are conducting major combat operations against Iran. This is not a drill. This is not a threat. This is happening right now. At approximately 2:30 a.m. Eastern Time on Saturday, February 28th, President Trump announced what the Department of Defense is calling Operation Epic Fury. The stated objective is to eliminate Iran's military capabilities, destroy its nuclear program, and bring about regime change. Trump called on the Iranian people to, quote, "take over your government when this is over." Israeli Prime Minister Netanyahu confirmed this is a joint operation, saying it will continue as long as necessary to remove what he called an existential threat. Israeli forces struck targets near the compound of Supreme Leader Khamenei in Tehran. Iran's foreign minister says Khamenei is alive, but confirmed that Iran may have lost senior military commanders, and Iran is retaliating. Missiles have been launched at U.S. military bases across the Persian Gulf. Explosions have been reported in Bahrain, where the U.S. Navy's Fifth Fleet is headquartered. Qatar, Jordan, the UAE, and Kuwait have all activated air defenses. Israel has declared a nationwide state of emergency, with civilians ordered to shelter in place. Sirens are blaring across the country. This is the most significant military escalation in the Middle East since the 2003 invasion of Iraq, and it is happening at the worst possible moment for financial markets. Gold jumped $100 an hour, hitting $5,278 per ounce. Silver closed Friday at $93 and was already surging before the attack began. Oil is spiking. Stock futures are collapsing. Bitcoin dumped over $4,000. But here's what nobody is talking about. This war didn't just start in a vacuum. It started at the exact moment when silver was already in the middle of its worst supply crisis in modern history, when COMEX had just revealed that 61% of its vault was demanded for March delivery, and when physical silver premiums were already 20% above paper prices. The war just poured gasoline on a fire that was already burning. And when markets open on Monday, the consequences could be historic. Let me explain exactly what this means for gold, silver, oil, and your money. Gold and silver have always been war metals. For 5,000 years, when empires go to war, people flee to precious metals. It happened in 1914. It happened in 1973 during the Yom Kippur War and the oil embargo. It happened in 2001. It happened in 2022 when Russia invaded Ukraine. But this time is different, and it's different for three specific reasons. Reason one, this war involves the Strait of Hormuz. 20% of the world's oil supply passes through this narrow waterway between Iran and Oman. Iran has already launched missiles at U.S. bases in Bahrain, Qatar, and the UAE, all countries that border the Persian Gulf. If Iran attempts to block or mine the Strait of Hormuz, oil prices could double overnight. And when oil doubles, inflation spikes. And when inflation spikes, gold and silver go parabolic. In the 1973 oil embargo, gold went from $42 to $197 in 18 months, a 469% increase. Silver went from $2 to $6 in the same period, a 200% increase. And that was with far less global financial leverage than we have today. Reason two, the timing couldn't be worse for the paper silver market. I documented in my last video that COMEX just reported 10,526 contracts standing for March delivery. 52 million ounces demanded against 86 million available. The vault was already under extreme stress before a single missile was fired. Now imagine what happens on Monday morning. Institutional investors who were already nervous about silver supply wake up to a Middle East war. They're not going to reduce their silver positions. They're going to increase them. Every sovereign wealth fund, every central bank, every family office that was on the fence about adding precious metals exposure just got pushed off the fence by cruise missiles hitting Tehran. More buying pressure on a market that was already short of physical metal. The margin of safety that was razor thin yesterday is now essentially zero. Reason three, Iran is a major player in the metal supply chain. Iran produces approximately 450 metric tons of refined silver annually and is a significant copper producer. More importantly, Iran's geographic position means that any disruption to shipping through the Persian Gulf affects the transport of precious metals from Central Asia, India, and the Gulf states. China, which controls roughly 60 to 70% of globally traded refined silver, gets a significant portion of its energy through the Strait of Hormuz. If Chinese energy costs spike because of the war, Chinese refining costs spike, Chinese silver export restrictions tighten further, and the global silver shortage gets worse. Gold already moved $100 an hour. It was at $5,178 on Thursday. It hit $5,278 on Friday as war tensions escalated. Multiple analysts are now projecting $5,500 or higher by end of next week if the conflict continues. Silver closed Friday at around $93 to $94. Market experts across India, Pakistan, Europe, and the US are unanimously projecting a sharp gap-up opening on Monday. If silver breaks above 95 and sustains, the path to $100 is wide open. 100 was already the consensus target before the war. The war just compressed the timeline. I need to talk about the Strait of Hormuz because it's the single most important variable in this entire equation. If you understand Hormuz, you understand why silver could go to 100 next week. The Strait of Hormuz is a narrow passage between Iran and Oman at the mouth of the Persian Gulf. It's approximately 21 miles wide at its narrowest point. Through this choke point flows roughly 20% of global oil supply and 25% of global liquefied natural gas. Every day, approximately 20 million barrels of oil pass through. Iran has explicitly threatened to close the Strait of Hormuz in the past. In 2012, during tensions over its nuclear program, Iran's Navy conducted exercises simulating a blockade. The U.S. responded by positioning 2 aircraft carrier groups in the region. Today, the situation is far more dangerous. Iran is not just threatening, it's actively launching missiles at every U.S. base within range. It has hit targets in Bahrain, attempted strikes on Qatar and the UAE, and launched missiles at Israel. If Iran decides to mine the strait or use its fleet of fast attack boats to disrupt shipping, the consequences are immediate. Oil at $100 to $150 per barrel, instant inflation spike, immediate safe haven stampede into gold and silver. Supply chains for everything, and from oil to metals to microchips, disrupted simultaneously. And here's the critical connection to silver that nobody else is making. The Strait of Hormuz isn't just an oil choke point, it's a metals transport choke point. Silver and gold bullion moving from Indian refineries, Gulf state depositories, and Central Asian mines to Western markets often transits through Gulf ports. Any disruption to Gulf shipping affects not just oil, it affects the physical movement of precious metals. At a time when COMEX registered silver is at 86 million ounces, and March delivery demands 52 million, any disruption to the physical supply chain could be catastrophic. You can't deliver silver to New York if the shipping lanes are closed. This is why I believe the market is dramatically underpricing the risk right now. Silver, at $94, assumes that the war will be contained, that the strait stays open, that shipping continues, and that COMEX can meet its delivery obligations. If any of those assumptions break, $100 isn't the ceiling, it's the floor. Last January, when Trump merely threatened tariffs on countries over Greenland control, silver spiked to a record of $95.87. That was just a threat about trade policy. This is actual combat operations against a country that controls one side of the world's most important shipping lane. Markets are closed this weekend, but the world isn't standing still. So let me tell you exactly what to watch for when markets open. Monday morning, March 2nd, Signal 1, gold's opening price. Gold closed Friday around $5,260. If it gaps above $5,300, the safe haven trade is confirmed and silver will follow. If gold opens above $5,400, we are in a new regime. Watch gold as the leading indicator. Signal 2, silver's gap. Silver closed around $93 to $94. Market experts across India, Pakistan, and Europe are unanimously expecting a sharp gap up. If silver opens above 95 and holds, the January all-time high of 121 is back on the table. If silver opens above 100, we are in uncharted territory and the COMEX delivery crisis becomes an immediate emergency. Signal 3, oil and the Strait of Hormuz. Oil was already trending higher on war expectations. If we get reports over the weekend of shipping disruptions, mine-laying operations, or attacks on tankers in the Gulf, oil could open at $80 or $90 per barrel. Watch for any statement from Iran about Hormuz. That's the nuclear option for oil markets. Signal 4, COMEX March delivery activity. Monday is the first delivery day of the March cycle. The daily delivery notice will tell us how many of those 10,526 standing contracts actually get issued for delivery. If the number is high, above 2,000 on day 1, it signals that war-driven urgency is accelerating the physical drain. Signal 5, SLV and PSLV flows. The iShares Silver Trust and the Sprott Physical. Silver Trust are the 2 largest silver ETFs. If Monday shows massive inflows, meaning billions of dollars flowing into these funds, it means institutional money is flooding into silver. SLV inflows require the authorized participants to acquire physical silver, which further drains available supply. Now, what could go wrong? What could cause silver to actually drop despite the war? If Iran and the U.S. reach a ceasefire or de-escalation agreement over the weekend, unlikely given the scale of operations, but possible, the war premium evaporates quickly. Silver could drop $5 to $10 on a peace announcement. If the CME responds to the crisis by raising margins again, which they've done 3 times already this year, leveraged traders could be forced to sell. This would create a temporary paper price drop even as physical demand surges. We've seen this pattern before. Paper price crashes while Shanghai and physical premiums diverge. And if the dollar strengthens significantly on a flight to safety trade, where global investors rush into U.S. treasuries rather than gold, that could create temporary headwinds for metals. However, given that the U.S. is the one attacking Iran, a flight into U.S. assets is less likely this time than in previous conflicts. My assessment based on the data, silver is more likely to go up than down from here. The combination of war, COMEX delivery stress, physical shortage, and safe haven demand creates the most bullish setup for precious metals since the 1970s. I want to be clear, I am not telling you to buy or sell anything. I am a researcher presenting data and historical parallels. What I am telling you is that the next 72 hours could define the precious metals market for the next decade. What happens between now and Wednesday will tell us whether this war creates a temporary spike or a permanent repricing of gold and silver. I will be covering this daily. Every morning I'll analyze the overnight developments, the delivery data, the price action, and the geopolitical moves. Subscribe and turn on notifications if you want real-time analysis as this unfolds. For the complete backstory on the COMEX delivery crisis that was already underway before the war, watch my video on the March delivery numbers. For the full silver story from $28 to $94, watch my complete timeline breakdown. Links are on this channel. This is Money and Empires. War has started. Gold is at 5,278. Silver was already in a crisis, and markets open in less than 48 hours. Get ready. Let me connect all the threads, because what's happening right now is the convergence of three separate crises that are about to amplify each other in ways the market has never seen. Crisis 1, the COMEX physical silver shortage. I've documented this extensively on this channel. 5 consecutive years of global supply deficits, 820 million ounces of cumulative shortfall. Registered inventory down 64% from 2020 highs. March demanding 61% of remaining inventory. Metal physically leaving the vault system. Shanghai pricing silver 20% above COMEX. London lease rates at 39%. This crisis was already at critical levels before today. Crisis 2. The geopolitical safe haven surge. Wars drive people into gold and silver. This is the biggest military operation in the Middle East since 2003. Every institutional investor, every central bank, every retail buyer who was considering precious metals just got a massive push. Monday's market opening will bring a tidal wave of buying pressure into gold and silver futures, ETFs, and physical dealers. Crisis 3, the energy and inflation shock. If the Strait of Hormuz is threatened, and Iran is actively attacking countries on its shores, oil prices could spike 50 to 100%. An oil spike means an inflation spike. An inflation spike means the Federal Reserve can't cut rates. Higher rates with higher inflation means stagflation. The worst possible environment for stocks and the best possible environment for precious metals. These three crises are now feeding into each other. The war increases safe haven demand for silver, but the silver market can't meet existing demand, let alone a war-driven surge. The physical shortage gets worse, pushing prices higher. Higher prices attract more buyers. More buyers drain more inventory. Less inventory means more stress. More stress means higher premiums. Higher premiums attract even more attention. It's a reflexive loop, and war just supercharged it. Here's a historical parallel that should give you chills. In October 1973, the Yom Kippur War began on October 6th. OPEC announced an oil embargo on October 17th. Gold was at $100 per ounce at the start of the war. By January 1980, less than 7 years later, gold hit $850. Silver went from under $3 to $50 in the same period. Obviously, the price levels are different today, but the mechanism is identical. War in the Middle East plus energy disruption plus currency debasement equals precious metals mania. And this time, the silver market starts the cycle already in deficit, already with depleted inventories and already with a broken paper pricing system.